Okay, this is going to be a brief video that we're going to talk about, some strategy, because if you watch the video where we talked about the mechanics of the pension plan or the private pension, and you know that there's the tax-free private pension, which is highly desirable. Tax-free income, you don't have to worry about 59.5. You don't have to worry about required minimum distributions. Your money passes on to your heirs tax-free. And so, obviously you need to do this if you have the funds and the assets to be able to fund that. Now, a lot of people have IRAs, SEPs, 401ks, and they have that, and they either do both, or they stop doing IRAs, 401ks, and start the tax-free program. But a lot of people ask, so what do I do with the asset here? And how do I protect myself because of this issue right here? And we touched on this in one of the other videos. So folks, look, down 37% in 2008, and you need a 58% return in order to overcome that down, right? So visually, if right here, 03 through 07, things are going pretty well. So you're doing this, and then bang, right? Now, you need 58% return the next year just to get back up to even. Okay, well, I don't know about you, but 58% returns don't come along very often. So even if you had a 10%, an average 10 or 12% return after this big down 37, you're still underwater. And as you can see here, over the past 4 years, and I pointed this out, what's incredibly fascinating about numbers, if you add these numbers up, this is basically 58%. Now, the challenge is the human side of this, right? So when this went down 37%, you need a 58. So this took, if you stayed in the market, if you weathered the storm, this 58% over 4 years, you're back to basically even. But guess what? Most people, something like this happens, they move all or a portion, and the plain fact of the matter is they just don't participate. Okay, they miss it. So the big question on our clients' minds is, all right, we've had 4 years of up, and here we are so far in 2013, we're up another 16%, right? So we've had 5 years, or I'm sorry, we've had 4.5 years of markets going up. And here's the question: why? Why have the markets been going up? I don't know. And so the question that we ask our clients, and it's already on their mind, it's on your mind as you're watching this video, is what are you doing to protect yourself from this happening again after this run up, when this question is looming? Okay, so that's what I want to talk about here on a strategy. So if you have an IRA, you have a 401k, and just so you know, you're not stuck on the 401k. You can take money out of your 401k. You have the ability, if your plan administrator allows it, and we do that research for you, we can help you, walk you through that. But your plan administrator can allow you to take a lump sum out. So let's just mechanically go through this. So you have your 401k, right? And you have your different funds and allocations and so forth. And every month you're putting money in. So let's say you're putting $500 a month in, and maybe your company's matching, maybe they're not. So you're putting money in, and this thing hopefully is growing over time. And you have a balance, and let's just pick a number, right? You have $200,000 in there. Now the challenge with the 401k, there's lots of options, but I've not found many 401k plans that have as one of these options that you can actually use some form of guaranteed option, meaning you can move a bunch or all your money into this, and it puts a floor under the $200,000. Now, yes, could you use a money market option within your 401k or some kind of fixed return? Yes, you can do that. They all have that. But the problem is, you go there, then what? How do you come back out? What's your strategy for coming back out? And that's the advantage of the private pension. And let me give you a visual. Let me give you myself some space here. So the point of the private pension, you've seen this in the mechanics where we walked through it, right, is that whatever you put in is absolutely guaranteed, cannot go down. So as the market goes up, you participate with it in whatever capacity the cap allows you to. The market goes down, you do not go down. That's your new floor. So then when the market comes up from these lows, like I pointed down here, you're not starting from this point here. You're starting from this point here. And this keeps going up and up. So you're kind of stuck in a 401k, but we can talk about this plan administration, and you can actually roll, let's say you have $200,000, you could roll a big chunk of this out, get a floor underneath it, and then keep contributing your $500 into the growth and equity portions, because the cool thing about this is, dollar cost averaging wins over time. And dollar cost averaging means that when the prices of a stock or mutual fund go down and you're putting in a set amount, you're actually buying more shares because it's at a lower price. And so the dollar cost averaging over time allows you to get more shares, and your money grows. But dollar cost averaging doesn't help you a whole lot on your lump sum. It only works with what you're putting in fresh money. Your lump sum is exposed. So that's on the 401k. The same thing on an IRA. So back to this question. What have you done over the past 4.5 years, whether you got your 58+% or you're somewhere in between? What have you done to protect yourself from this happening again? And I'm not saying it's going to go down 37, but folks, look, I mean, we're in a tough time. This is going up. Why? Why is it going up? So you can be an innocent bystander and just sit there and watch it, and watch your 401k turn into a 201k, or if you have your IRA just sitting there, you have a big chunk of money in your IRA. Our clients are using the private pension, putting a floor underneath it, so when something happens from this situation here, they don't go with the downdraft. They're absolutely protected. Okay, so I just wanted to walk through that strategy, and I hope that makes sense to you. Thanks.